Welcome to Talk Tickers. Today we're digging into PAR Technology's Q3 2025 earnings call because there was a lot going on here and the market's reaction was pretty wild. All right, let's get right into it because what we saw after PAR reported was frankly a little confusing at first glance. It really seemed like the market and the headlines were telling two totally different stories. So, the earnings drop on November 6th, and immediately you've got these conflicting headlines popping up everywhere. On one hand, you're seeing stories about PAR missing its earnings estimates, but then on the other, you've got reports calling it a robust quarter and highlighting a big beat on revenue. So for any investor, that's just, it's instant confusion, right? Which is it? But the market? Oh, the market made up its mind real quick. The stock just exploded. It shot up over 16% the very next day. And get this, it was on more than double the average volume. That's not just a little pop. That's big money saying, we like what we see. So what gives? What did the market see that some of those headlines completely missed? Well, here's the key. Wall Street decided to look right past that small 2-cent GAAP earnings miss. They basically said, yeah, okay, the accounting number is what it is, but let's look at the real engine of the business. They focused on the stuff that actually shows where this company is headed. Okay, so let's pull back the curtain and decode what made this quarter so strong in the market's eyes. First up, the top line. Revenue came in at $119.2 million. Now, analysts were expecting something closer to $112 million, so that's a beat of almost 6%. I mean, that's not just squeaking by, that's a really solid beat. Then there's the metric that every software investor loves, annual recurring revenue, or ARR. It climbed to nearly $300 million, which is up 22% from last year. But here's the kicker. Management came out and said they actually expect that growth to speed up going into Q4. That's exactly the kind of language investors want to hear. And this is a big deal. For the first time in a while, they're generating cash from their operations. $8.4 million to be exact. For a growth company that's been in investment mode, burning cash, flipping to positive cash flow is a massive milestone. It tells you the business is becoming more self-sufficient and that their cost controls are actually working. And the growth really was firing on all cylinders. You had the high-margin subscription revenue up 25%, that's the good stuff, but you also saw this huge 32% jump in hardware. Now, management gave a little color on that, saying some of it was customers getting their orders in before potential tariffs hit. So a little bit of a pull forward, but still strong demand across the board. All right, but it wasn't just about the numbers this quarter. Management really used this earnings call to announce a new chapter for the company. They are going all in on a new AI-native strategy. The CEO, Savneet Singh, kept using this one phrase. It's built in, not bolted on. And that's a really important distinction. He's saying this isn't some gimmicky AI feature they're just tacking on to their existing products. No, they're fundamentally re-architecting their entire platform with an AI intelligence layer at its core. So what does that actually look like? Well, they launched what they're calling the PAR AI stack. Basically, step one is pulling all the data from all their different systems into one unified intelligence layer. Then they build on top of that with tools like Coach AI. Think about it. A busy restaurant manager can just ask a simple question in plain English, like, hey, which of my locations is struggling with drive-through times today, and get an immediate, actionable answer. That's a game changer. And this whole AI story, it's not just talk. It's backed up by proof that they're getting their house in order. They pointed to their operating expenses, which have dropped from 60% of revenue down to 44% in just 18 months. They showed how their all-in-one platform strategy is working, with over 70% of new deals including multiple products. And they're actually delivering on massive contracts, like getting Burger King rolled out faster than planned. So everything sounds great, right? A strong quarter, a new AI vision. But, and this is a big but, we have to zoom out and look at the bigger picture. That one day 16% pop is nice, but it doesn't erase what's been happening for the past year. And yeah, the reality is pretty stark. Even with that post-earnings jump, the stock is still down almost 60% over the last year. Meanwhile, the S&P 500 is up over 11%. That is a massive, massive underperformance. So why the huge disconnect? Well, there's a good amount of skepticism baked into this stock, and for a few reasons. One, the company's execution has been choppy in the past. Two, that path to real, consistent GAAP profitability, it's still a ways off. Three, they're fighting in a really tough space against huge competitors like Toast. And finally, the whole restaurant tech space has just gotten re-rated by the market. The high-flying valuations are gone. So with all that in mind, The good quarter, the AI story, but also the stock's ugly past. Here's our take on PAR Technology heading into the next earnings call. All right, for our official rating, we're landing on market perform. Here's why. We are positive on their ability to accelerate ARR growth in Q4. We think they'll deliver on that. We're neutral on profitability. We expect them to keep making progress on a non-GAAP basis, but true GAAP profit is a different story. The big wildcard, though, is the stock itself. We think it's going to stay volatile, and the thing that could really move the needle is news of another big Tier 1 customer signing on the dotted line. That would be huge validation. So to put it simply, here's the bull versus bear case. The bull case is that they execute, turn their huge backlog into revenue, and land another whale of a client to prove this quarter was the real deal. The bear case? It's pretty simple. They just stumble on execution and fail to deliver the consistency that investors are now demanding. And finally, let's talk about a potential trade idea that came to mind during the call. Management was really vocal about looking at M&A, especially now that valuations for smaller players in their space have come way down. So a pretty interesting, though definitely aggressive, idea could be a pair trade. You go long PAR, betting on their execution, and at the same time, you short some of those smaller, single-product competitors that are ripe for a potential acquisition. Of course, this is not financial advice.